So thank you everyone for joining us for our Investing 101 webinar happening today. We're super excited about it. But before we do, we just want to quickly introduce ourselves. So everyone, my name is Kastakara. I am the Director of College Success for the Fulfillment Fund, and I'll just quickly let the team introduce themselves as well. So we can get started with Olivia.
Hi everybody, my name is Olivia Della O. I'm one of the College Success Advisors here at Fulfillment Fund. Thank you for joining us. I'm really excited for today.
And Mauro.
Hi everyone, my name is Mauro. I'm also one of the College Success Advisors here at Fulfillment Fund. Yeah, like Olivia mentioned, thanks for joining us, and really excited to learn with everyone as well.
And last but not least, Kim.
Hello everyone, my name is Kim Lin. I'm also a College Success Advisor, and welcome, and super excited to see you all here today.
Great, thank you. So the real reason we're all here today is for our special guest presenter. His name is Doug Pryor. He is the manager of the Los Angeles office over at Wedbush Securities, where he has been working since 2015. But over the course of his 25-year career, he's also held positions at Morgan Stanley and at Stifel Financial. He received his master's in finance from Cal State Fullerton. Doug, we're super excited to have you here with us. Thank you so much. And the floor is yours. Take it away, Doug.
All right, thank you. So it's nice to see everybody. And I experienced this format not too long ago. I went through a program with Wharton, and the entire experience was virtual. So much like what you've been doing here, I think it's actually pretty great. It makes it a lot easier. I'm sure a lot of you are saving time driving to get to class, and so it's one of the things that we got with the pandemic was much increase in technology and more people willing to utilize it. So glad to be here, and thanks for having me. So we're going to be talking a little bit about Investing 101. So we'll just kind of see how much you all know, and we'll take it through. And if anybody wants to stop and ask questions in between, feel free. We'll ask some questions along the way just to make sure you're involved and paying attention. So I'm just going to go ahead and share my screen, and we'll go ahead and get started here. So as they said, I've been in the business since 1994. So I graduated from Cal State Fullerton, had a finance degree, and started with a company called Dean Witter at the time that ultimately became Morgan Stanley. And with my finance degree, I thought I knew all that I needed to know to become a financial advisor, and I learned very quickly that I was wrong. So even 25 years later, I just took another pretty extensive class learning about the markets, and so you can never stop learning. So let me get to. So can you all see the screen here? Account types, we're good? Okay, good. So just kind of generally speaking, this is when you go to open up an account and establish an account to start investing, there are different account types that you can establish. And I just wanted to talk pretty quickly about the differences of them. You'll see here taxable accounts. This is most likely the type of account that you might open initially, and it might be in your name, or you might open an account with somebody else. It might be a spouse, it might be a parent, it might be a sibling, something like that, and that's where the joint account comes in. And trust accounts are what people will open up when they get to the point that they want to have a clear understanding of what will happen to their assets when they pass away. So anytime that you open a single account or a joint account, it's not so clear what you might want to have happen to that money when you pass away and who you'd want to get it. But trusts are, they establish it quite clearly. So as people get older, we see more and more trust accounts. And the reason why these are taxable accounts is because whenever you buy something and you ultimately sell it, assuming you've done a great job investing, when you sell it, you have a gain. So you bought it at a certain price and you sell it at a higher price at a later date. The government's going to want to take some of that gains in the form of capital gains tax. So that's why we refer to these as taxable accounts. And so the next type of account is a tax deferred, or what you would more commonly refer to as a retirement account. And we have two different ways that that can be established. We have a traditional 401k or a traditional IRA. And let me tell you the difference with the 401k and the IRA. A 401k is what you will establish when you're working with somebody, an employer. They will offer a 401k that they can take money from your paycheck and a certain amount that you determine and invest it in some way. And what makes it a traditional 401k is it's reducing your taxes at the time. So if over a year you put $1,000 into a traditional 401k, you will lower your taxable income by that same $1,000. And so depending on your tax bracket, let's just say you're paying 30% of your money in taxes. That means you saved $300 by investing in that traditional 401k that year. A traditional IRA is when you don't have an employer-sponsored plan like a 401k. So the government allows you to open up a traditional IRA. You can contribute up to a certain amount of money each year. I think currently that's $6,000. And then the same thing happens to where whatever you put into it, you get a tax break on your income that year. Now, when you go to take money out, when you retire, that's when the government takes their taxes in that regard. So you saved taxes when you put the money in, but you pay the taxes when you take the money out. Now, here's where the difference of a Roth 401k and a Roth IRA comes in. A Roth 401k is the same. It's an employer-sponsored plan. So when you work for a company, they'll offer this Roth 401k. You put that $1,000 in, like I described with the traditional 401k, but you don't get a tax break at the time. So you don't save taxes then, that 30% that I mentioned. But what the benefit is that $1,000 can now grow completely tax-free until you go to take it out. And these are obviously retirement accounts, so you're not taking them out until sometime in the long future when you go to retire. So you can kind of think about, what $1,000 might grow to in that period of time, and you get all of that tax-free. So big difference there. Traditional, the Roth IRA works the same. What you put in, you don't get a tax break at the time. You get to take it out tax-free when you retire, and you have all of that growth tax-free. So kind of the idea is the younger you are, the more benefit you get from putting money into a Roth 401k or a Roth IRA. Chances are you're in a lower tax bracket. You have lower income at the time. And when you go to retire, you would probably be in a much higher tax bracket. So the benefits are pretty great. So I highly recommend all of you, when you start contributing to a 401k or an IRA, and hopefully I'll convince you here as we're talking to start earlier rather than later. I would highly suggest you do the Roth version rather than the traditional version. So, so any questions about account types before we move on? All right, so let me move to the next slide here. And I'm just going to give you this comparison here and talk about the power of compound interest. And so hopefully when I'm done with this, you'll all realize that, yes, I need to go out and open up a Roth IRA or establish, something with my company's 401k and get started. So compound interest, and what the idea behind that is that you start making interest on your interest. So if you have a CD and it pays you 6% interest, the first year, let's say it's $1,000 and they pay you that $60. If you go to reinvest in that CD again, now you have $1,060. You'll make 6% on the $1,000 again, but you'll also make 6% on the $60. So that's what the idea of compound interest is. And so I'm going to take you through an illustration that will really show you what the power of compound interest can be. So we've got a comparison here. So we've got a 24-year-old who decides that they want to start investing $2,000 per year into a Roth IRA. And they're going to do that every year on their birthday and stop on their 30th birthday. And they're going to put their money, that $2,000, in the S&P. And we're just going to assume that over the life, it gets a 10% average annual return. That's about the historical average of the S&P. So we'll just use that. Then you compare that with a 30-year-old who starts investing when they're 30 and then invests every year until they're the age 65. And so again, let's just, assume that they're doing it on their birthday. So we have somebody that's investing 7 times, right? So 24, 25, 26, so on, age 30. And then the 30-year-old has to do it 35 times or 36. And so we're going to try to guess who has more money. So I think we've got a poll that we can show if the first poll can get put up here. And so just asking the question, who do you think has more money? So the 24-year-old invested about, what would that be? $16,000 or $14,000, and the 30-year-old invested 70. So let's give it a minute or so to let everybody answer. How many participants do we have today? 25 or so, maybe?
Yes, in total we have about 27.
Okay, so we've had 19 answering. Give it another 15 seconds. We still got about 6 or 7 people who haven't answered. All right, why don't we go ahead and end the poll and then share the results there. So can everybody see the answer? All right, so pretty similar in guessing here. So we've got 57% said the 30-year-old and 43% said the 24-year-old. So let's see what our answer is. All right, so in this comparison, we've got the 24-year-old who invested $14,000, and with their interest or their growth at age 30, they ended up with $18,974.34. The 30-year-old started with 0 at age 30, invested $70,000. And the 30-year-old at age 65 has $542,000 roughly, and the 24-year-old has $533,000. So those of you who answered the 30-year-old got the answer right this time. But you can see the difference is pretty slim. So about $9,000 difference. But then go back and remember that what was it? That this is a $14,000 investment that the 24-year-old made. And by the time they retired, they had a little over $500,000 in their account. So we're going to go to the next comparison, where the only difference that we're going to make here is that the 24-year-old decided to start a year earlier and invest at 23. So I think, did we do a poll for this one? I think. Okay, so let's go ahead and put the poll up. So now that you know what the answer was with the first one, let's see what you all guess as to who will have more money this time around. So yeah, most of you are picking the 23-year-old. And so let's just see what we got. So that 23-year-old now at the age of 30 has $22,800 when they hit 30, and they invested $16,000 total. So just $2,000 more. And they ended up with about $110,000 more at retirement. So these are real numbers. This is what the power of compound interest can be. This is saving $16,000 and stopping. And the person that started at 30 and had to invest $2,000 a year until the age 65 never caught up. It's not, $100,000 is a pretty significant difference. So that's why hopefully after this, when all of you start working full time, some of you might be already, if you have the opportunity to invest in a 401k, I would start as early as possible. Even if you did, $50 a month, you can see the significance to that. And most of the time when you invest in a company 401k, your company will match some of that money as well. So now think about if you were to put in $2,000 in your first year from 23 on, and your company matched another $2,000. Now you're talking about you've invested $16,000, and your account would have roughly $1.3 million. So I'm not saying you should stop when you're 30. but I'm just trying to illustrate how important it is to start earlier and the benefits of that. So any questions about any of that? All right, keep moving on here. So this is just a little illustration of the different asset classes that you can invest in. I'm just speaking pretty broadly here. Of course, they can get a lot more detailed and have a lot more. Most of the time you hear about the S&P 500 or the Dow Jones. Those are market indexes. The Dow Jones has 30 different companies that span across the different industries that we can invest in. And then the S&P is just simply the 500 largest stocks traded on the exchange. So you can just kind of think of them as our 500 largest companies that we have domestically here. And they typically make up large cap companies, which are billions and billions of dollars in size. Apple would be that. Mid cap size companies, and then you have your small cap companies that are a lot of biotech companies are in the small cap space. And then fixed income, you have corporate debt, which is what our publicly traded companies will issue for their own debt. The government, the Fed, will issue treasuries, bills, and bonds. And then every state has their cities will issue debt as well in their municipalities. And those are tax-free type investments. So you might hear munis quite a bit. And so that's what those are, is that our cities within our states will issue debt, and the people who invest in those get the benefit of tax-free income with those. Commodities are your precious metals, gold, silver, platinum. Oil is probably the biggest investment when it comes to commodities, and agriculture. So your cotton, your grain, corn, these different kinds of things. And alternative investments are, I wouldn't say they're new, but they're getting more and more popular. And these are the types of things you hear: hedge funds. People are able to short in things like alternative investments or buy options. And then the newest popular topic is cryptocurrencies. So Bitcoin, Ethereum, Doji, that's obviously a big topic nowadays, cryptocurrencies. And maybe someday we'll add meme stocks to an asset class. So those will become a little bit popular, especially for your generation. So let's flip here. So next, just question for you all. When you look at these 6 different asset classes here, I think we have a question to ask on: what do you think is considered the most risky investment out of all these different options here? So give a guess as to what you believe is the riskiest thing that you can invest in out of this group. So let's see. So everybody knew that government bonds is the safest by not answering that it's the risky. So that is true. The government bonds are considered the least amount of risk. And in fact, when we think about risk-free, we will talk about the Treasury bill, which is the 3-month government bond in a sense. So the government will borrow money for 3 months. That is what we consider risk-free. And we use that calculation a lot in a lot of the models when we're determining what we think the markets might do. The actual answer is small cap equities, and international equities is a good guess as well. But small cap equities throughout history is the most volatile. And so with risk, you typically get reward. But the answer is small cap equities to that. So these are the kind of companies that, at one point Tesla started as a small cap company and became a large cap company. So it's a great example of the potential that you can have with a small cap company. But unfortunately, for every Tesla, there's probably 5 or 6 other companies that failed. And that's where the risk comes in. As you may have invested in Tesla, you may have invested in 5 other small cap companies, and may have lost all of your money in 5 of them, but luckily Tesla more than made up for that difference as it grew from a small cap company to a large cap. But they are the most aggressive or risky assets. And how we illustrate that is, so when I'm talking with clients and I'm advising them on what risky assets are. I like to show this pyramid because it gives a really good idea that the less risk something is, the more stable it is in a sense. So it's the foundation of your pyramid. And as you go up, your risk increases. And hopefully you can see here the different things that involve that risk. So options, futures, spread betting, those are all incredibly aggressive type investments, but at the same time, your reward can be great. And then you see your small cap. So those of you that answered large cap, you weren't thinking too incorrectly there, you were right behind it. And then equity mutual funds and so on. So gold has always been kind of the foundation, of stability. And, whenever people are in a panic or they feel like there's going to be a recession or a depression, people start to buy more and more gold to feel like they're safe or secure. So in my 25 years of experience, you'll be amazed how many people at some point believe that the market is going to zero, money is going to be devalued completely, and they do want to have gold under their mattress for protection. So it has happened in our history there for people wanting to have gold. So let me move on and just talk about measuring risk. There's really two things that we use a lot. There are other things, but just to keep things a little bit simple and moving along, you might hear standard deviation or beta a lot. So standard deviation is what a lot of mutual funds will use to express what their risk is. And so you might remember from statistics or anything like that, standard deviations, and 1 time, 2 times, or 3 times standard deviation. It's basically a statistic that measures the dispersion of a data set relative to its mean. So what does ultimately that mean? So let's say you've got the S&P, and throughout history, the Standard & Poor's 500 has averaged 10%. But it's standard, or I'm sorry, I'm not sure if I said that right. The average return is 10%, but its standard deviation is 20. So what that means is in one standard deviation, the market can go down 20% from that average or go up 20% from that average. So from statistics, you might know that one standard deviation is 68% of the time. So if you invest in the Standard & Poor's 500 and the average is 10% and standard deviation is 20, 68% of the time, the market could be down 10% in any given year or up 30% in any given year. And so 2 standard deviations would be 40. And so you can do your calculations on that. So the higher the standard deviation, the more volatility that you could have, or the greater the variance from its mean that you can have. So going back to our example before, with small cap stocks, is the average return of a small cap company might be 15%, which is higher than the S&P, but its standard deviation might be 30. So now you're talking about one standard deviation would be anywhere from down 15% to up 45%, and then 2 standard deviations from that. So when I'm talking to clients about risk, that's the type of thing that I take them through is yes, the S&P could average 10%, but you have to understand that there's a possibility it could go down 20 or 25% in any given year. And we have to determine as advisors is how they would feel in a situation like that and how they would react to a situation like that. Are they going to panic and try to sell everything? Or are they going to think that it's just, it's not a permanent thing? They might try to invest more, those types of things. But that's what standard deviation is. And then beta is a measure of the volatility or systemic risk of a security or portfolio in comparison to the market as a whole. So now what does that mean? So the S&P 500 has a beta of 1. So the market, we consider that to be a beta of 1. Whatever the market does, that's what the S&P does. So it's kind of comparing itself to itself. So a investment that has, say, a beta of 1.2, it's basically saying that if the market were to go up 10%, something that has a beta of 1.2 would go up 20% more than that. So in this case, 12. So if you own something that has a beta of 1.2 and the market goes up 10% that particular year, your investment should go up 12%. It has a higher beta. But what it also means is if the market goes down 10%, your investment should go down 12%. So you've got something that has more volatility, has more risk. So you're going to get rewarded in good times, but you're also going to pay a little bit higher price in bad times. So when you're analyzing fund managers, they're going to show those kinds of ratios a lot. And people like me will ask managers what their standard deviation is, what their beta is, so we can understand how much risk we're putting our clients in compared to the market. So any questions on that so far? All right, we'll just keep moving here. So now we've got two different things with, I mentioned in beta, systemic risk and non-systemic risk. And so, what do these two things mean? So systemic risk, this is the risk you cannot diversify away if you're going to own equities. So if you're going to own the S&P 500, then systemic risk says that by owning those equities, you just simply have risk that you can't control. Non-systemic risk is what an individual company might have. And so if you own Apple today and Apple has supply chain issues with China and they suddenly can't build the iPhone because they can't get the product that they need and their sales come to a halt, that's going to affect Apple individually. It may affect other companies who are making or buying products from China as well with their supply chains, but that's something that's specific to Apple. And so by the way to eliminate non-systemic risk is to buy more stocks than Apple. So the more individual stocks that you have, the less dependent you are on one stock from having any type of issues. So that's what non-systemic risk is. Systemic risk, going back to that, is, like I said, what you can't diversify away. And it's just simply what happens to the market when certain things happen. And so I put here what a black swan event. And what a black swan event is something that you simply can't predict and plan for. So I know all of you are on mute, but if anybody wants to chime in on, give me an example of what you might know of that's a black swan event, something that you can think in our history that happened that you would consider a black swan event. So anybody want to unmute and throw something out there?
The Great Depression.
That's one. How about another? That's it's a big event in our history. There's three that I can think of that you would have just never thought would happen.
Someone in the chat wrote the 2008 recession.
The financial crisis, that is definitely one where we got over leveraged. We were borrowing way too much money. And we found that out pretty much overnight. Everybody had 3 houses that couldn't afford the first one. And that was a domino effect. I definitely lived through that. And I had clients at that time that were calling and demanding that they come down and get cash out of their account right then. And it was very stressful, but we did live through it. But that's one. Another one would be 9/11. Just really not the kind of thing that we could predict. And so that's a systemic risk. The entire market went down. There was a massive adjustment. And just by simply owning equities, it did not matter what stock you owned. They all were negatively impacted from that event. So, a massive earthquake on the West Coast, not to scare everybody, but something like that would cause a systemic risk. Everybody would feel that economically if something like that were to happen on the West Coast, like we continually hear is going to happen at some point. So diversification is key to try to get rid of the non-systemic risk. But simply investing in the market, that's something that you just can't simply avoid. All right, so ways for you to invest is through either a financial advisor like myself. You might be familiar with a lot of the companies that are out there. I work for a company called Wedbush. I started with Morgan Stanley, Merrill Lynch is another one, Wells Fargo, UBS. These are all what we would consider full service firms. You can invest directly with different mutual fund companies. American Funds is one of the biggest and most popular out there. And then you have your online platforms. And then what we're seeing that's getting more popular are apps like Robinhood. And my opinion on something like Robinhood is it's a little scary, to be honest, because I think they're making it very easy to invest and do transactions very quickly at a very low cost, which is fine. But part of the job that I do as a financial advisor and even some of these online platforms is to try to manage the emotional roller coaster that comes with investing and to make sure that you stay properly diversified and you're making the right decisions and doing the right things. And Robinhood as an app is making it very easy to make quick decisions, emotional decisions, and maybe even invest your paycheck, because we all believe we're going to make the right decision and everything's going to work out great, and that doesn't always happen. So I'm a little concerned with apps like Robinhood, just simply how easy they're making it and how quickly you can make decisions, and a lot of those decisions can be emotional ones, and I'm not sure that they'll end up being the right one in the long run. So be careful with that. I know they're very popular with the younger group, but things move fast, and as much as we think we can make money every time, it doesn't happen all the time. And so it kind of leaves me with I think that's my last slide here, and we can open it up for questions, but I'll just talk about what took place about maybe 4 or 5 months ago with GameStop. And you all might be familiar with it, and maybe you were part of it. I think it's what is it? The Wall Street something was somewhat behind it, and so what that really was GameStop is a company that sells video games, and it's a retail store, and it was kind of looking like our version of Blockbuster, where Netflix came in and really kind of ruined a brick and mortar's operation and ended up bankrupting the company for a better alternative. And so GameStop was looking pretty similar. So there were a lot of hedge fund managers, a lot of people with a lot of money that felt GameStop was going out of business and they were going to no longer exist. And if you feel that way about a publicly traded company, you short the stock. And so shorting a stock is basically selling the stock first and buying it back at a later date. So if you sell it now and you plan on buying it back later, your thought is you're going to buy it back when it's gone down quite a bit and make money in reverse. And so, but in order to do that, you actually have to kind of look at it as you're going to a friend and you say, I know you own 1,000 shares of GameStop. I want to borrow your shares and I'm going to sell those shares in the market today and I'm going to collect the money for it, but I'm going to buy it back later and I'll give you the shares back when I buy it back. And so it's a promise, it's an agreement. So that's kind of what's happening. So now you, in a sense, have two investors. You've got the one that owns it, and now you've got the one that has already sold it. But the one that sold it has to buy it back at some point so that they can give the shares back to the one that currently owns it. So now what happened was all these people got involved and they started buying GameStop and driving the stock up. So all these people that had borrowed their friend's stock and was short it was watching the stock go up. And then when you have stock like that in a company like mine, we get a little nervous because you've borrowed the money. And at some point we say, okay, you either need to add more money to your account to continue to borrow this, or we're going to force you to sell it. And so, or in this case, buy it back. So now you have all the people that were buying it on this side, and all the people that were short it, had already borrowed it, were being forced to buy it back. So now you have two forces driving the stock up. And it happened fast, it happened quick, and GameStop went from $60 a share to $400 a share. And so you can imagine if somebody was short GameStop at 60, thinking it was going to zero, and suddenly had to buy it back at $400 a share, just imagine how much they lost. And it was very rapid, very quick. But that's where I talk about Robinhood. Is it worries me because people could be on the other side of that. There were people who thought GameStop was going to go to 500 or 600, that they then got in at 400 buying it and then had the stock collapse. So there's just as many people, unfortunately, that lost on the short going up as lost buying it later, thinking it was going to go higher and then watching it go down pretty considerably. So that's what took place there, and that kind of became the popular meme stock category. AMC fell into that category. Beyond Meat, there were some others that did, but GameStop was, that was not like anything I had seen before in my entire 25-year career. And we had a client that wasn't my client, but luckily, but they started with about $3 million in their account, and they shorted GameStop. And not only did they lose the $3 million, but they owed us $1.2 million when it was done. So, so their account went completely to zero. Luckily, their net worth was far more than the 3 million. So there wasn't just that, but in a matter of days, they not only lost the 3 million, but had to pull 1.2 million from another account to just get it to zero. So you can see how quickly things can go against you. So be careful with that if you're doing this all on your own. So that's what I have. We can open it up for questions or anything else that you'd like to discuss or ask.
Awesome. Thanks, Doug. That was great. And thank you for explaining the shorting process. I think it was like you did a really good job of walking us through that. I think a lot of us have seen that movie. Was it The Big Short?
Big Short.
Yeah.
Yeah, they did quite well. They were the ones that predicted the financial crisis early. So obviously they were right when things started going down. They made money when that happened. You can kind of question whether that was the right thing to do, but they did, and they have a lot of assets now because of it.
Great, thank you for that. We actually have a question on the chat. It's a little specific, so let's see if you can answer it. One of our students wants to know what type of retirement funds do doctors use, or do they invest in their own portfolio?
Well, doctors, they don't, they'll invest in the same types of things that others will. So a lot of them will create, what you might call like an individual 401k plan, because, typically a doctor will have their own practice, and then they might have 4 or 5 staff. And so what they'll establish a 401k to where they can obviously contribute into that, and then their 4 or 5 employees can contribute into their own account. And then from there, they can invest in, the equity mutual funds, individual stocks, bonds, everything. But there isn't anything unique or different that they would be able to invest in. It'd be a 401k, or if it's just a doctor by themselves, they might do something that we call a SEP IRA, self-employed pension IRA, that type of thing. But generally they'll do what all the other types of companies or individuals might be able to do.
Great, thank you for that response, Doug. We have another student who wants to know if you can explain what NFTs are.
Oh, well, my 16-year-old son probably could a lot better than me. I think if I understand what he tells me, it's kind of like, think about a digital piece of art or a digital sports card. I know that's what he's very much into, is the basketball NFTs, to where, LeBron James will have a video of a play, and you actually get the opportunity to own that video. So you purchase it through an account. You are the owner of that video. It's almost a form of a cryptocurrency. And then there becomes a market of, demand with how popular that particular play and player is to determine what the price of that is. So it's kind of like the modern day version of baseball cards, from what I can gather. But then it's obviously gone into digital art and all kinds of other things that you can own in some type of digital fashion. That's about the best I could describe it. Like I said, I'm sure my 16-year-old could tell you far more than me on that one.
Okay, thank you for that, Doug. We have another one, and it's more of a, I guess, clarification, but they want to know if you can just maybe quickly talk about the differences again between the Roth IRA and the Roth 401k. So it's a 3-part question. So that's the first. So we'll start with that.
Start with that. Yes. So the Roth 401k is offered to you through an employer. So if you go to work for somebody, especially like a larger corporation, they're going to have a 401k to where you can contribute money through your paycheck. So you might say, I want 4% of all my income to go into your 401k. And the Roth part of it is that you don't get a tax break when that 4% goes in, but that money grows tax-free. And so you saw what the power that could be by the time you retire, what that is. So again, a 401k is a retirement account. So you don't want to be utilizing that if you're saving for a house or you're saving for any type of expense that might be in the near future. This is long-term retirement type money. And then the Roth IRA is in the, you might work part-time, you might work for a company, a small company, like say maybe a restaurant doesn't offer a 401k. A Roth IRA is what you would open when you don't have a company-sponsored plan to contribute to. And it works the same way. You can put money in, you don't get a tax break at the time, but it grows tax-free.
Great, thank you for that. And then the other part is, when do you think is the right time for someone to start investing, someone so young to start investing?
As early as you can. I mean, it really, when you think about all the different things that might be big purchase items in your life, retirement's definitely one. I know it's very hard to think so long-term about that, but, showing you what it can do by starting early, it really lowers the pressure when you become somebody like my age. I'm 51 now. I've got kids in college. I'm, the retirement thing starting to think, creep into my brain. When am I going to be able to? How much am I going to have? That type of thing. And it's because I started so early. I graduated when I was 23, and it started my job 2 weeks after graduation, and immediately started investing in my 401k. And because of that, I can worry a lot less about it. But saving for a car, saving for a house, all these different purchases that you would have to make, the sooner that you can start investing, the sooner you start benefiting from that compound interest. So yeah, I try to recommend to people, even if you're just doing a summer job, try to commit to having some of that money get put away and start your investment account at that time.
Great. And then on that note, right, the third part, which is, you kind of touched on it, but they want to know if there is any age requirement for any of these type of investments.
You do have to be 18. So you have to, if you are under 18, you do have to have a custodian open the account with you. It's what we call a Uniform Trust of Minors Act. So you would have, in that case, a custodian, and then the beneficiary of that would be the minor. And then it can be invested the same way. You're not limited to what you invest in, but unfortunately, until you're 18, you would have to have an adult attached to that account. Once you're 18, you can open your own account in your name.
Yeah, I think all our students on this call should be 18 or over.
I figured with college, we're probably over 18, but in case somebody was talking about younger sibling or something like that. So.
Okay, great. Another question is, do you recommend having gold as an asset?
I do have gold in my portfolios right now, not a large percentage. I have about 2 or 3% of my portfolios in gold. It's just kind of it's a hedge. And, typically when the markets go down or people are worried about inflation, gold is a good investment to have. And so I do have gold in my portfolios. I wouldn't recommend a lot of it. It's just not an asset class that grows strongly. And usually when the market's doing well, it doesn't do well. And throughout history, the market does well far more often than it doesn't. So it can kind of give you an idea over the long term how gold might do. So I certainly wouldn't put a lot of somebody's money into gold, but it's a good idea to have some.
Great. Another question that just came in. What would be the minimum recommended amount to put into a Roth IRA account?
With that, I mean, you really, if you started and committed to something monthly, I would say, $50 a month so that you can have that money go into a mutual fund, an equity mutual fund, and just keep doing that. But if you were just going to do a one-time investment, then you probably want to have about $1,000 or more just so you can get the benefits of the fund and whatever expenses might come with that. But if you can make a commitment monthly, then as little as $50 a month would be good.
Great. And then I can just ask another follow-up question. Talked about the 401k retirement account. What would you say would be an ideal contribution for someone who's just started? Or is there an ideal contribution? Should you try to base it on what your employer is matching? Is there different factors that go into that?
Yeah, so that's a very good question. And what I do typically answer is if they can afford it, if somebody can afford it, at a minimum, invest what gets you the maximum match from your corporation. It's kind of like leaving money on the table. If you can afford $1,000 a year and your company is willing to match that $1,000, then do it. And if you can only do 500, then do 500. You could at least get the other 500. But in the scenario where somebody can afford to do 1,000, but they only do 500, you kind of left $500 on the table. Your company was willing to give you another 500, but you didn't take advantage of it. Mm-hmm. So I would say at a minimum, try to do what your company's willing to match. And then if you still can afford more, do that. But I also advise people to not go too overboard when it comes to their retirement plans, because more often than not, my clients are at the age where the government's forcing them to take money out because back then they didn't have Roth options. So they had to do the traditional version to where they got the tax break when they put the money in, but they pay taxes when they take the money out. Mm-hmm. And most of them are in a situation now to where they don't need the money. They have assets in other places for their income. But the government's forcing them to take the money out, and then they're paying taxes. So I also advise people to not go too overboard when it comes to retirement accounts, because you could end up having, just more than you need by that time. So it's a balance. That's what we try to work through when we do our financial plans and our financial models. What's the right amount? And we try to predict that. Great. We do a lot more as financial advisors than people realize.
No, yeah, and I think you brought up a great point about how Robinhood, everybody kind of just lets emotions take over, and I think that's extremely true. And we've heard situations where students have lost, thousands of dollars because they just invest in something that maybe they didn't really do the most research in. So. Yeah.
Don't they like shoot out confetti whenever you buy something? It's like this big celebration, So yeah, you have to be careful with that. It's a big part of my job is preventing people from doing irrational things. And, most of the time it's selling when they shouldn't. They'll get worried about what's going on in the market and they panic and they want to get out, and I have to walk them and talk them through that. And then at the flip side, we'll have a conservative person that will call me and want to buy GameStop. After it's gone up from 60 to 300, and it's like, no, you can't handle that volatility. I know you won't sleep at night when it drops. So we really have to play psychologists as well.
We have one final question. Do you have any recommendations for best places to start a Roth IRA?
As far as like who to open the account with, or how to invest it?
I think who to open the account with.
Well, a company like mine is good. Wedbush, you'll get a financial advisor. You'll have somebody help you. I think at a minimum, you'd want to be if you don't have a financial advisor, you want to work with Schwab or Fidelity, because I think they're much better at helping the emotional part. Like I said, it's the apps that worry me. At least the Schwabs and the Fidelities really do provide a lot of good, valuable information. And so that's a good alternative as well. But if you're talking about investing, how to invest the money at your age, stay away from fixed income. You don't need it. It's too conservative. You have plenty of time to invest. Now, if you're investing something that you'll need in 6 months, then that's different, because the market can have something bad happen and that we don't know about, and now whatever you've been saving for so long can be negatively impacted. But if you're talking about a 5, 10, 15 year time period of what you'd be investing, then at your ages, you want to be in the equity markets. They outperform over the long run. They consistently beat inflation, and you can withstand downturns because you have the time for it to come back. And throughout history, it always has. So equity mutual funds is definitely the type of thing that you would want to invest in if you start now.
Perfect. All right. Thank you, Doug. I think those are all the questions we have. Really quick, I'm going to just put something. Students, we have a survey. If you don't mind taking that, we'd really appreciate your feedback. Doug, thank you so much for this amazing presentation. I think we all learned a lot, students and staff alike. We always talk about how we take so much away from this, and we're probably going to go and try to figure out what we need to do as far as our investments as well. So we'll be in touch, Doug. But once again, go ahead. Sorry.
I was just going to say, I took the screen down, but if you need me to put it back up with my contact information, if you have questions, give me a call, email me. We'll try to answer. My Wharton professors were, great with that, so I want to return the favor for sure. So any questions, just let me know.
Most definitely. Thank you once again, Doug. We really appreciate you doing for this. I know our students learned a lot. We can't thank you enough for volunteering to do something like this for us. Thank you once again. I really appreciate it. Man, we appreciate it.
Thank you.
All right, students, thank you so much for attending the event. We hope that you took a lot out of it. I'm sure that you did. But we are done for today. We're going to stick around for a little bit. The team and I, if you have any additional questions, but other than that, thank you so much. Enjoy the rest of your Thursday evening.